is a hedge fund? A hedge fund is similar to other investment funds in the sense that it takes money from outside investors, invests their money to attempt to achieve returns expected by those investors, and charge management fees. However, that is where all the similarities end. It is hard to define hedge funds in a few short sentences. In this video by BankingPrep, we're going to talk about 4 characteristics of hedge funds, as well as their 4 commonly used investing strategies. 1. Only accredited investors are allowed to invest in hedge funds. The Accredited Investor Standard is a regulation by the Securities and Exchange Commission, SEC, to protect average investors from losing large amounts of money from risky investments. This regulation is to ensure that investors who invest in risky financial products have sufficient fund and financial knowledge. A person is qualified to be an accredited investor if he or she has an individual net worth or joint net worth with that person's spouse exceeding $1 million, had an individual income in excess of $200,000 or $300,000 in joint income with a spouse in each of the 2 most recent years, and likely to earn the same income level in the current year. Is the director, executive officer, or general partner of the issuer of the securities being offered or sold. Here's a fun fact. If hedge funds were a country, it would be twice the size of Russia in terms of GDP. Although few investors can invest in hedge funds, as of 2019, the total assets under management, AUM, by hedge funds amounts to a staggering $3 trillion. Investing style. Since hedge funds are private firms and not subject to regulations by the authorities, they can invest in any type of financial products and employ different investment strategies that are not permitted in traditional investment funds. This allows hedge funds to potentially earn excessive returns and make money regardless of the direction of the market. For example, a hedge fund manager can short sell a security if he believes bad economic conditions is going to affect its price, while a mutual fund manager may not be allowed to take part in short selling, even if he highly suspects that the stock is going down. A hedge fund can also invest in risky financial products such as derivatives and shares of new private companies. In addition, hedge funds are permitted to use leverage to amplify returns on their investments. This allows them to outperform the market and traditional funds by a large margin, but also makes investing much more risky. Hedge fund managers invest their own money in the fund. Unlike managers of traditional funds, all hedge fund managers put a substantial amount of their own money into the funds they manage. Moreover, whatever profits attributed to the manager from investing, a large part of it will be reinvested into the hedge fund. This makes hedge fund managers more trustworthy in the eyes of the investors, since the manager's interest is more aligned with that of the investors. High management fees. While traditional investment funds only charge fees as low as 0.05% of assets under management, AUM, hedge funds can charge a lot more than that. You probably have heard of the 2 and 20 fee structure, which means they charge 2% of AUM as management fees and 20% performance fees on the profits made. The 2 and 20 fee structure is not standard across all hedge funds. Rather, it is close to the average fees charged by hedge funds. Due to the increasing competition, some hedge funds only charge 1% management fees and less than 20% performance fees. That being said, some hedge funds that have a history of outperforming the market by double digits can charge management fees as high as 4% and performance fees as high as 50%. For example, the hedge fund SAC Capital run by Steve Cohen is known to charge 3% management fees and 50% performance fees from 1992 to 2013. Even though these fees seemed ridiculous, during that period, the average annual returns net of fees to the investors was 30%. Hedge fund strategies. Hedge funds employ many different investing strategies, and they can roughly be classified into 4 categories. 1. Long or short equity. A long or short equity strategy means taking a long position on, i.e. buy, an undervalued stock, and taking a short position, short sell, on another overvalued stock. Usually the two stocks are very similar, which means the two companies are in the same industry and are close competitors. Example: let's say there are two companies called Company A and Company B. The hedge fund manager believes that Company A is going to perform better than Company B, but he is uncertain about the direction of the market. If the market goes up, the stocks of both A and B will go up, but A will go up more than B. If the market goes down, the stocks of both A and B will go down, but A will depreciate less than B. Thus, the hedge fund manager decides to buy, let's say, $1 million worth of stock A, and short the same amount, $1 million of stock B. If conditions are good, stock A goes up 10% and B goes up 5%. The net gain of the fund manager will be 5% of $1 million. If conditions are bad, causing the price of stock A to go down 5% and B 10%, the fund will still have a net gain of 5% of $1 million. 2. Relative value arbitrage. This strategy also involves taking long and short positions of two securities simultaneously. The premise for employing relative value arbitrage strategy is based on the price relationship between two securities, i.e. their relative values. Example: let's hypothesize that there are Company C and Company D. These two companies are very similar in nature, and thus their stocks have historically traded at the same price. On a beautiful day, for no reasons, stock C trades at $40 per share, and stock D trades at $35 per share. Believing that the prices will converge, the hedge fund manager will short stock C and long stock D. This way, when the prices of two stocks go back to equilibrium at $36, for example, the fund will have made $1 on stock D and $4 on stock C. 3. Event-driven. As the name suggests, this form of strategy focuses on major events happening to a company, such as mergers and acquisitions, bankruptcies, initial public offerings, IPO, or share buybacks. These events can cause temporary mispricing of securities, which creates an opportunity for hedge funds' profit. Example: when there is an announcement that Company E is considering buying Company F, and the hedge fund manager believes that the acquisition deal is going to happen, and Company E likely would overpay to acquire F. Before the deal finalized, the hedge fund manager would buy shares of the target company, F, and short the shares of Company E. Alternatively, he could also take a bigger long position on the target company F and not short the acquirer's share. The purchase of the target company with a premium will usually cause the target company's share to increase. As a result, the hedge fund will have earned a profit from this acquisition event. 4. Global macro. This strategy focuses on macroeconomic trends associated with political or economic policies of governments, economic cycles, or new technologies. The hedge funds that practice this strategy will forecast the effects of these factors on equities, debt, currencies, or other financial products. Arguably, the most famous example of this strategy was hedge fund manager George Soros, shorting the British pound in 1992. Many people regarded George Soros as the guy who broke the Bank of England. In 1992, Soros saw the British pound being unstable and the government had to devalue the currency sooner or later, He took a massive short position of $10 billion on the British pound. The British government tried to maintain their currency's exchange rate by buying the pound, but failed. The British pound was let to float on the 16th of September 1992 and depreciated significantly. George Soros made more than $1 billion from the event, the biggest profit from short selling in history. If you aspire to work in a hedge fund someday, subscribe to our YouTube channel and visit our website to learn more about the career path to hedge funds.